I'm going to rate all my stocks today from best to worst. Actually, I'm going to switch that. We're going to start with the worst stock and move to the best. I think this is fun, but good practice for us investors to do, as it can show us if we are investing our money where we feel it matters most. At the end of the video, I will share my full portfolio and its performance and some really interesting things. So let's dive in, and I'm going to start again with the worst stock and work my way to the best. I will keep it uniform and share the same info for each, including my ETFs. Those are going to be a part of this ranking. So my stock that is in last place, the 17th place, I have 17 holdings, is 3M, ticker symbol MMM. Now 3M makes up 2.08% of my portfolio, and it is currently at a negative 33.25% unrealized loss. So 3M. Lawsuits is what is mainly putting this company in last place, as it hinders 3M's financials, reputation, and its future. You have the earplugs lawsuit, which is the largest mass tort litigation in U.S. history. You have forever chemicals lawsuits that seem like they will create forever problems for 3M. This just touches the surface of why it's in last place. I want to sell out, and I know I will most likely have to sell at a loss, but I think I can at least wait till the Fed lowers rates, which I believe will make the stock market rise as a whole, and then I plan on selling. That, or maybe a settlement of those big lawsuits creates positive impact on this company. We'll see, but this is my stock in last place. In 16th place is AT&T. Their ticker symbol is T. Now AT&T makes up 1.62% of my portfolio and is currently at a negative 24.76% loss. Now, I will say I think T is moving in the right direction, aka they're lowering their debt, but simply put, this is a company that will always be lethargic as a performer due to its high capital expenditures, regulations on this industry, and not to mention the increase in competition. I do want to sell, but have confidence I can sell in the green within the next couple of years. In 15th place is Warner Bros. Discovery, ticker symbol WBD. Now Warner Bros. Makes up 0.61% of my portfolio and is currently at a negative 40.91% loss. So biggest loss percentage wise. I actually like this company and think they have a strong chance of becoming profitable due to their delivery of quality content, and the streaming potential with Max is very strong if they can up their content volume. I know many people that love the content they produce, and I am one of them. I still may sell, and like AT&T, I think I can sell in the green someday. Why I probably won't keep this stock is because Netflix just does it better and is the clear winner, and I don't see Max ever being in first place, but I could see them being in a strong second or third place. Now, the 14th place stock is an ETF, and that's Vanguard Total International Stock Index Fund, ticker symbol VXUS. Now, this international fund makes up 2.28% of my portfolio, and it is currently at a 0.51% gain, so barely in the green. This one is to simply get international exposure and diversification with my portfolio. I want to always keep it between a 2 and 2.5% allocation position, and I just think there is no economy like the US's, and so it will never get above that 2.5% for me, but I still want the exposure, as there are good international economies and companies that I want a slice of. Now in 13th place is another ETF, that's the Fidelity Utilities Index Fund, ticker symbol FUTY. Now FUTY makes up 1.33% of my portfolio, and it is currently at a 4.22% gain. I hold this one as I don't own a pure utility stock. AT&T may be the closest to that, so I figured I will hold an ETF. Now utilities to me are needed, so it offers stability, but I don't expect it to grow much, so I will also keep this a low allocation and may even exit someday if I want to concentrate my portfolio more with less holdings. That's when this would be on the chopping block. Now in 12th place is another ETF. This is a Fidelity Materials Index ETF, ticker symbol FMAT. And if your name is Matt, I am not cussing you out. That's just the ticker symbol. Now FMAT makes up 1.57% of my portfolio, and it is currently at a 5.22% gain. I hold this for the same reason I hold the Utilities ETF, but feel this one offers a little more potential on the growth side, and it is performing 1% better than FUTY right now. So it's why I place it above the Utilities one, and why it makes my list as the 12th place. I would again put this ETF on the chopping block if I want to concentrate my portfolio more. Now in 11th place is CSCO, ticker symbol CSCO. CSCO makes up 1.6% of my portfolio and is currently at a 13.08% gain. So CSCO is a mixed bag for me. They are moving towards a more subscription-based model, and we have seen what positives that can create, aka Adobe, Microsoft, but of course they need to prove they can successfully implement this type of model, as it can fail. Just because other companies have done it does not mean CSCO can. So far it's been in slow adoption mode, and that worries me, but I also think that due to their excellent financials, they have time to figure things out to make it successful. I am keeping this as a small allocation as there is risk, but I lean more towards the transition being successful in the long term. I will just have to be patient. Now we're in the top 10. In 10th place is Johnson & Johnson, ticker symbol J&J. Johnson & Johnson makes up 2.51% of my portfolio, and it's currently at a 0.94% loss, so barely in the red. I like Johnson & Johnson, but have been disappointed in their performance since I've owned the stock for a few years now. I like that they are focusing on medical devices and pharmaceuticals, which should prove to be high growth and very profitable. They did spin off their consumer health division, which is a slower growth, and I do think this is a good move. My main negative is similar to 3M's, and that is lawsuits. This company, being a pharmaceuticals and medical devices business, just puts them at more risk for lawsuits, and we have heard of the talc lawsuits related to the consumer health division, but I think the other two divisions are just as vulnerable. Now, this company does have good financials, and one I am okay holding for now to see what the spinoff does for them over the next couple of years, but I will keep it more towards the low end allocation of my portfolio. So in 9th place, we have Home Depot, ticker symbol HD. Now, Home Depot makes up 4.76% of my portfolio and is currently at a 5.88% gain. In the home improvement industry, Home Depot is king, and in my opinion is the best of the best overall. They embrace innovation and technology, they utilize their debt wisely, and I think offer stability in one's portfolio despite what the housing market does. I think Home Depot may underperform versus the general market for a few years, but not to the level analysts are predicting, as with the housing boom that occurred over the pandemic, that created at least a decade's worth of upgrades and fixes that homeowners will be doing, and Home Depot is viewed as the better value by customers, so I think they will get the majority of dollars spent during harder economic times. Also, there's still a housing shortage, so that will help Home Depot. So not the perfect stock, but a solid investment. Now in 8th place is Realty Income, ticker symbol O. Now Realty Income makes up 4.78% of my portfolio, and it is currently at a 5.81% loss. The REITs have been hit hard lately. With high interest rates, I have been saying this for a while, but now is the time to be accumulating quality REITs, and Realty Income is a quality company that offers diversity, solid financials, and a path for future growth, as it has been acquiring other REITs to expand its portfolio. I think if you buy now, you will thank yourself later. Its current dividend yield is a 5.67%, and its average is a 4.26% yield over the last 5 years, so that's great dependable passive income to be collecting and reinvesting. Next, in 7th place is an ETF, probably the most popular one, is Schwab. That's the Schwab US Dividend Equity ETF, ticker symbol SCHD. Now, SCHD makes up 14.85% of my portfolio, and it is currently at a 3.88% gain. A diversified dividend-focused ETF paying out almost 4% yield when the 5-year average is 3%, plus you get stock price appreciation. Serve it up is all I can say. This ETF has been getting a lot of hate lately, but I just think investors are being emotional and short-sighted with this one. I've done videos on this fund and will do more in the future because I think it offers healthy passive income plus stability in one's portfolio, which is a great combination. I want to make this a 20 to 25% allocation position in my portfolio. In 6th place is an ETF, that's the Fidelity Energy Index ETF, ticker symbol FENY. Now, FENY makes up 0.66% of my portfolio, and it is currently at a massive 74.07% gain. Unfortunately, I do have that small position. I think energy, especially oil and gas, is looked at as the big bad wolf, when in reality it is a bee that pollinates our lives. We don't realize how dependent we are on oil and gas, and I think it still has decades of outperformance. Plus, you have companies like Exxon investing in green energy. So an ETF that is capturing all of that is great. The negative for me is that I did not invest more when I had the chance, So with any healthy dip, I will add more. I think this one will outperform. In fifth place is Union Pacific, ticker symbol UNP. Now, Union Pacific makes up 8.88% of my portfolio, and it's currently at a 13.9% gain. The most efficient way to transport goods is by train. This industry has high barriers of entry, so it's extremely unlikely a new company would enter the mix, and it's not a very popular stock, so I think it gets overlooked and is usually at a good valuation for the stability and potential it offers. A stock I have no problem keeping between a 5 to 10% allocation of my portfolio. In fourth place is Vici, ticker symbol VICI. Now Vici makes up 9.39% of my portfolio, and it is currently at a negative 3.96% loss. An experiential REIT that is very concentrated on the Vegas Strip, but the Vegas Strip is more diversified than ever and is continuously expanding that diversity of offerings. Think gambling, sports, concerts, world-class fine dining, etc. So I think the value of Vegas's properties have decades of strong appreciation ahead of them, and Vici will massively benefit from that, and I believe this REIT will be one of the top outperformers in its sector. I also think it is highly undervalued right now, and I have been adding heavily, obviously, as it is now almost 10% of my portfolio, as you see. So much more to say about this REIT, but I will save it for future videos. In third place is Amazon, ticker symbol AMZN. Now, Amazon makes up 11.85% of my portfolio and is currently at a 43.16% gain. For me, this is a stock in my portfolio that I feel can be the best performer over the next 10 years. It's got impressive offerings that are sticky, subscription-based, and should only grow as this company is all about convenience. And to me, that is where consumers flock to, and that demand will only grow in our busy society. Think about it. Its cloud offering, Amazon Web Services, is firmly in first place. Amazon Prime is something virtually everyone I know has. It's also getting into the online pharmacy business. It's streaming sports and owns popular products such as the Ring cameras. I will just say this. Search all the businesses, products, and services of Amazon and you will be shocked at how many they have. I think it is a misunderstood company, and I predict it will offer huge gains to investors over the next decade or two. Now in second place is S&P Global, ticker symbol SPGI. Now S&P Global makes up 13.3% of my portfolio and is currently at a 16.04% gain. I think this is a sleeper of a company. Not many know or talk about this stock. It not only is a ratings company, but a huge data company. So its customers depend on the ratings and the data it offers to make strategic, important decisions. Also, with a lot of debt instruments like bonds, there will be a large volume expiring in a few years. That is going to be a huge revenue boost for this company. Plus, how popular is the S&P 500? Well, S&P Global owns and maintains that along with the Dow Jones indices. So I really like this company and think it's low risk and high reward and very deserving of second place. That leaves us with first place, which is Microsoft, ticker symbol MSFT. Now, Microsoft makes up a massive 17.92% of my portfolio, and it's currently at a massive 58.54% gain. This one makes the number one spot for me mainly for one reason. It's the stock I have the most confidence in, and to me that is extremely important. It also offers low risk and high reward. It's the stock that has made me the most money easily. The leadership of a company is very important, and one that cannot be measured from looking at financial statements. The CEO of Microsoft, Satya Nadella, is brilliant, yet very down to earth. I have watched many interviews with him, and he is just impressive, and he delivers. Now, Microsoft is mainly a subscription-based revenue-generating company, and I love that because that is dependable, recurring revenue that is easier to raise prices on because many businesses depend on these services. Think of Office 365, Azure Cloud, LinkedIn, and you have other areas that are offering growth like gaming. These services are very sturdy and offer huge future growth potential. Plus, we now have OpenAI to add to the mix that will only accelerate the growth of virtually all of Microsoft's offerings as they are integrating it in across its products and services. Of course, there has been some OpenAI drama recently, but any way you look at it, it seems to be in Microsoft's favor. It is pricey right now, so I am just holding, but with any meaningful dip, I will add more. I am fine with this being between a 15 to 20% allocation of my portfolio. So here are all my stocks ranked from the worst to best. And speaking of my portfolio, let's look at the performance chart I share with every single video. I am dedicated to being transparent and honest, so please subscribe if you like that type of content, and your support means a lot. Now, we already talked about the gains and losses and allocation of my holdings, so I want to quickly point out two other metrics that I have seen huge improvements in. First is the overall growth of my portfolio. I am up 13.43%. To put that in perspective, I ended 2022 at a negative 6% loss, so over 19% growth year to date. I am proud of that performance. Not only that, but if you look at my dividend yield versus yield on cost, that has greatly improved and they are now neck and neck. What this is saying is the dividend yield of these holdings at current market value produce collectively a 3.11% dividend yield versus the dividend yield of these holdings at cost, aka the price I purchased them at. So even though I bought these stocks over the last 3 years, you could buy them now collectively and get the same yield as me. So the goal is to have the yield on cost much higher than the dividend yield at market value. I want to be able to say that my stocks that I purchased over the years are producing a higher yield than what the current stock is yielding. So for most this year, my yield on cost was lower than the dividend yield at market value, meaning someone could buy them and get a better yield than me. So now it has caught up and it should improve from here, and that is my expectation. So let me know if you disagree with any of my rankings, and if you plan on doing this with your own portfolio to put things in a different perspective. I think it's a great exercise to do. Thank you so much for your time and support. We will see you soon on Mark Arnold's Finance.